January 2nd, 2026. This isn't speculation, folks. It's not a forecast and definitely not a theory on what might occur. It's here. The switch got flipped midnight Beijing time, January 1st. China's export ban went live. In just 48 hours, the global silver market started fracturing in real time. If you caught my last update, you knew this was inbound, but the sheer velocity and violence of this move, it's rattled even the most seasoned stackers out there. No calm adjustment period here, just pure chaos. Industrial buyers panicked. Retail stackers scrambled for ounces. Behind closed doors, procurement teams, refiners, and the big boys all realized the same thing. The silver market, they knew, is dead. Today's breakdown is the day one aftermath. No opinions, no hype, just the raw facts on what went down when China dropped the hammer, the market reaction, and why this next phase is way more dangerous than most people expect. At the heart of this crisis is a fact the herd ignored. China controls 60 to 70% of refined silver supply. When the boss cuts exports overnight, it's not just tight, it's a total supply shock. These shocks don't hit headlines first. They hit via fear, hesitation, and the sudden realization that paper contracts don't keep factories running. Only physical metal does. Hours after the ban, volatility spiked and confidence cracked. Charts told one story, but real damage was hidden where physical silver availability was evaporating. This sets the foundation because once you grasp the structural change, everything that follows is inevitable. If you care about wealth, stick around. Subscribe so you don't miss the updates. Drop a 1 below if you stack physical silver or a 2 if you're just trading the paper price action. To get why the reaction was violent, you need to know what the ban means in practice, not headlines. Midnight, January 1st, 2026. China's Commerce Ministry enforced the new export licensing system. This wasn't a warning shot. It was a lockout. Overnight, the rules of the global silver trade changed, and most were totally unprepared for how restrictive this framework truly is. Only 44 companies got approved to export silver for 2026 and 2027. Just 44. Before this, hundreds of Chinese firms were exporting, feeding refiners, industry, and bullion dealers in the West. The new rules effectively wipe out small and mid-sized exporters entirely. To qualify, a firm needs annual production capacity of at least 80 tons, a proven export record from 2022 through 2024, a $30 million credit line, and direct state approval. Miss one single requirement, and you are out. This isn't a temporary bottleneck, it's structural exclusion. The companies that historically supplied Western electronics, solar producers, automotive suppliers, and bullion dealers are no longer legally allowed to export metal. They didn't slow down shipments, they stopped. When the nation controlling the majority of refined silver kicks most exporters out overnight, the impact is immediate and brutal. Supply chains lack redundancy for this kind of shock. Contracts assume business as usual. Inventories run on just-in-time models. There is absolutely no buffer for a sudden disappearance of supply from the world's dominant source. This is why the market reaction wasn't gradual, it was instant. Buyers realized within hours this wasn't about price negotiation anymore, it was about access. And once access becomes uncertain, price becomes secondary. The first 48 hours weren't about speculation, they were about pure survival positioning. This is the bedrock of everything that follows. Once exporters vanish, the stress flows downstream, and that stress is already showing up in spot prices, premiums, and behavior across the entire market. The first place stress surfaced was price, but not how most expected. Leading up to the ban, silver traded in a controlled range as markets tried to price the risk. On December 30th and 31st, silver hovered around $75 to $78 an ounce. Volatility was elevated, but the structure looked familiar. Traders thought it would be gradual. They were wrong. When Asian markets opened January 1st, the reaction was immediate and violent. Silver surged to $84 an ounce within hours, printing a new all-time high. This wasn't algorithmic momentum or a slow reprice. It was panic buying. Large players rushed for exposure at the same time overwhelming liquidity. For a brief window, the market revealed what happens when fear collides with thin supply. Then came the pullback. Profit-taking hit technical selling kicked in and geopolitical headlines temporarily cooled. safe haven demand. By the session close, silver retraced to the mid-70s. To the untrained eye, it looked like a rejection. In reality, it was a controlled retreat. The market had just absorbed a historic shock and didn't collapse. By January 2nd, silver was swinging violently between $73 and $76, posting intraday moves of 3 to 5%. This volatility isn't normal. It signals stress, but focusing only on spot misses the real story. The screen price reflects paper contracts. It does not reflect true physical availability. The real signal is what happened simultaneously in the physical market. While paper prices pulled back, the cost to actually hold silver began to explode. This divergence is critical. When spot stalls but premiums rise, it means supply is breaking underneath the surface. That is exactly what the market is telling us right now. Price didn't fail. It exposed the fault lines, and those cracks lead directly into the physical market where the disconnect between paper and reality has become impossible to ignore. If you want to know what's really happening, stop looking at the spot price and start watching the premiums. Spot is the paper reference. Premiums are the truth, and since the ban went live, premiums across the physical silver market have exploded in a way that leaves no room for denial. In Shanghai, physical silver was trading roughly $8 to $10 an ounce above COMEX spot before the ban. That was already high. Within 48 hours of the restriction report showed premiums jumping to $12 to $15 above spot, with desperate buyers paying even more. When silver shows $75 on a screen but costs close to $90 to actually get in the world's largest metals hub, the message is clear. Physical supply is breaking. The pattern is spreading globally. In the States, American Silver Eagles that normally carry a $3 to $5 premium are now listing at $8 to $12 over spot at major dealers. Generic rounds that sold $2 or $3 over spot are now $6 to $8 higher if available at all. 100-ounce bars when found command premiums of 10 to 15% over spot. Many dealers aren't even quoting prices, they're quoting delivery times. Europe is the same. Dealers in the UK and the EU report doubled or tripled premiums, widespread out of stock notices and delivery timelines stretching from days into weeks. India, a major silver consumer due to industry and culture, is bidding aggressively as Chinese exports dry up, pushing those premiums to record levels. This is what a real shortage looks like. Paper markets can pretend supply exists. Physical markets cannot. Premiums rise because metal is scarce, not because of sentiment. When buyers are willing to pay far above spot just to secure delivery, that paper price becomes irrelevant. While retail stackers are just starting to feel this pressure, something far more serious is unfolding behind closed doors among industrial users. That's where the real panic has begun. While retail investors notice higher premiums and empty shelves, the real crisis is quietly unfolding in boardrooms and procurement offices. Industrial users don't have the luxury of waiting for prices to stabilize. Silver isn't an investment for them, it's a required input. Since the ban took effect, many of these companies have been pushed into full emergency mode. Electronics makers felt the impact first. One big producer in Southeast Asia heard first quarter 2026 deliveries would be delayed 4 to 6 weeks. In a just-in-time world, that's catastrophic. Assembly lines don't pause, they shut down. A delay of this magnitude doesn't just squeeze margins, it threatens output. Solar fabricators now face a much harsher reality. Silver paste is key for photovoltaic production, and European producers were notified by Chinese suppliers that no new contracts will be taken for first quarter delivery. Existing deals may be honored, but future supply is shaky. Some vendors are not even willing to quote prices because they do not know if they can source the metal at all. That level of uncertainty is unprecedented. Medical firms are reporting similar chaos. Silver is vital for wound care, antimicrobial coatings, and specialized gear. Suppliers are triggering force majeure clauses, unable to promise pricing or delivery dates. In the auto and EV space, the squeeze is intensifying fast. Every electric vehicle needs heavy silver content for power electronics and control systems. With global EV output scaling up, physical demand is relentless. Data shows that some EV part makers in Europe and North America are grabbing silver at $85 to $90 per ounce equivalent for guaranteed delivery. These aren't speculators chasing gains. These are factories paying whatever it takes to escape production shutdowns. When industrial users ignore price sensitivity, the market has crossed a critical threshold. And this is why one single remark from late December suddenly carries far more weight than it did back then. On December 27th, 2025 days before the ban hit, Elon Musk replied publicly to the news with a short but telling note. "This is not good. Silver is needed in many industrial processes. At the time, many ignored it as a casual tweet or exaggeration. 48 hours into the ban, it now reads like an understatement." Musk's firms rely heavily on silver. Tesla uses it in every car it makes, from electrical contacts to power management systems. SpaceX needs silver for high-performance aerospace and comms applications. When someone with direct skin in industrial supply chains flags concern, it is worth paying attention. And Musk is not alone. CEOs, CFOs, and buyers across multiple sectors are now facing the same crisis at the same time. Supply certainty is gone. This is where market behavior becomes truly revealing. Institutional pros and banks entities that usually like liquidity and paper exposure have begun quietly swapping paper positions for allocated physical silver. Exchange-traded funds that were once convenient proxies are now seen as risk layers. When big money demands delivery instead of rolling contracts, it signals zero confidence in the paper system's ability to hold up under stress. Meanwhile, banks and big industrial users are building private stacks not for profit, but for survival. This is strategic stockpiling, the type that happens when players believe supply may go unavailable at any price. This trend accelerates shortages because every ounce pulled from circulation tightens the system further. We are witnessing a shift in price discovery itself. For decades, futures markets set silver's price, and physical markets followed. That dynamic is now reversing. Physical markets are starting to lead, and paper prices struggle to keep up. Once delivery cost becomes the real benchmark, traditional exchanges lose control. And that loss of control becomes especially dangerous when you look at the exchange at the heart of the paper market itself. The pressure point in this crisis is the COMEX, where silver futures anchor global paper pricing. On the surface, trading flows as normal. Contracts swap hands, liquidity looks intact, and settlement mechanisms stay in place. But beneath that surface, the structure is under severe strain. As of January 1st, 2026, registered silver stock on the COMEX stands at roughly 127 million ounces. This is the metal actually available for delivery. Against that, open interest represents over 1.1 billion ounces of paper silver. Simply put, for every ounce of deliverable metal, there are nearly 9 paper claims. That ratio only works when most players never ask for physical delivery. That assumption is now failing. In early December, nearly 48 million ounces were grabbed for delivery in just a few trading days, draining over a third of registered inventory. That was before China's ban even took effect. Now the urge to stand for delivery is far stronger. Physical premiums are spiking and arbitrage gaps are widening. When paper silver trades near $75, but physical metal sells far higher elsewhere, pressure on the exchange becomes relentless. This is how paper systems break through arithmetic, not emotion. London shows similar stress. Vault stocks have dropped sharply and lease rates have surged, signaling huge difficulty sourcing metal for immediate delivery. High lease rates are not noise. They are a warning. The paper market relies on confidence. Once that trust erodes, stability vanishes quickly. As the paper market cracks, another bottleneck tightens the system, even further refining. Switzerland plays a key role in the global silver supply chain, making much of the high-purity metal needed for industrial use. Refineries there turn raw silver into the precise forms demanded by electronics, medical, and energy makers. When refining slows, supply does not just tighten, it freezes. In late December, Swiss refiners began using stricter export review protocols. Compliance checks rose, documentation needs expanded, and shipment approvals slowed. After China's ban went live, these delays intensified. Refiners now prioritize long-term contract holders and strategic clients, while spot buyers face extended wait times or outright refusals. This creates a risky illusion. Raw silver may still exist in the system, but if it can't be refined and delivered to spec, it is functionally unavailable. Industrial users don't need silver someday. They need it now in exact form at exact purity. Any disruption in refining turns a supply issue into a production crisis. Meanwhile, this deficit is accelerating a broader geopolitical shift. China's silver ban is not a solo move. It fits a clear pattern of resource control seen over the past decade. Rare earths, antimony, tungsten, gallium, and germanium have all been subject to export limits. Silver is simply the latest addition to that list. In response, the United States listed silver as a critical mineral in late 2025. That nod confirms its strategic value, but it does not create supply. Domestic output covers only a fraction of global demand, and new mines take years to develop. There is no short-term fix. As nations vie for limited material, this becomes more than a market issue. It becomes a strategic contest, and silver is now firmly on that chessboard. To see why this crisis won't resolve quickly, you must look at the underlying supply and demand math. Global silver demand in 2025 hit roughly 1.24 billion ounces. Total supply, including mine output and recycling, was closer to 1.1 billion ounces. That leaves a structural deficit of over 200 million ounces in a single year. This was not a fluke. It was the fifth straight year of deficit. From 2021 through 2025, cumulative shortfalls ate nearly an entire year's worth of global output. That missing silver did not vanish. It came from above-ground inventories, vault holdings, and strategic stockpiles built up over decades. Those reserves are now dangerously depleted. Industrial demand is the driving force. Solar energy alone eats hundreds of millions of ounces annually. Electronics, electric vehicles, medical uses, and advanced manufacturing continue to grow regardless of price. Silver is not optional in these processes. It is essential. The problem is that supply cannot react fast to higher prices. Roughly 3/4 of silver comes as a byproduct of copper, zinc, lead, and gold mining. Output decisions are driven by base metal economics, not silver prices. Even if silver doubles, output won't surge. Primary silver mines account for only a small slice of supply, and new projects take 8 to 12 years to bring online. Recycling offers little relief. Much industrial silver is trapped in products where recovery is tough or uneconomical. Panels, electronics, and medical devices are not easily recycled at scale. The conclusion is unavoidable. There is no rapid solution. China's export ban did not create this deficit. It exposed it. And once a structural shortage becomes visible, markets do not revert quietly. 48 hours into China's silver export ban, one conclusion is unavoidable. This is no longer a theoretical risk. It is a live structural reset. The silver market is forced to confront a reality it postponed for years, where paper promises collide with physical limits. That collision has already begun. For decades, silver pricing relied on leverage and trust that delivery would rarely be demanded. That confidence is fading. Industrial users are no longer price sensitive, they are supply sensitive. Institutions are no longer comfy with exposure alone, they want metal. When availability becomes uncertain, price stops acting as a ceiling and starts acting as a signal. The key question is not if silver hits 100 fiat dollars. It is how the manipulation breaks down. A steady run means wild spot swings, huge premiums, and the market accepting the true physical price. A chaotic squeeze means empty vaults, force majeure, and a total collapse of confidence in paper. When physical breaks paper, the move is never quiet. The lesson here is key. The rigged markets don't fail because spot rises. They fail when confidence vanishes. Confidence in valid stock, confidence in delivery, confidence in paper. Once that trust is broken, money moves to safety and fast. Ignore the daily tamps. Spot price is noise. The squeeze is the signal. Silver is scarce, stackers are holding, and time is not on the banker's side. Knowing you hold real wealth matters more right now than ever. If this DD helped you see the truth, subscribe to stay ahead of the crash. Share this with potential stackers and stack your thoughts in the comments. The silver squeeze story is far from being over.